Hello everyone. Welcome to the Model Tax Convention session provided by the OECD Tax Center in Republic of Korea. My name is Jang. I'm just working for the Yulchon LLC, one of the law firm in Korea measuring in tax matters. I joined there 5 years ago, but before that, I worked for the government for about 20 years, measuring in tax treaty matters. So what I'm going to talk about today is on the Model Tax Convention matter, especially focusing on OECD Model Convention and UN Model Convention. It will take around 2 hours and comprising of 4 sessions. So I hope you enjoy our discussion during my sessions. Thank you. Model Tax Convention is the model for the 2 countries who would like to have tax treaty with each other. So Model Tax Convention is basically a baseline for the negotiation between 2 countries who are going to have a tax treaty with each other. Well, there are 2 major objectives of tax convention. First one is avoidance of double taxation, and second, prevention of fiscal evasion. So, Model Tax Convention is for the benchmark of the negotiator, for the negotiator to have negotiation with each other to make their own tax convention or tax treaty. For the instruction purpose, I will use convention and treaty interchangingly. Well, in the international law, there is a subtle difference between convention and tax treaty. However, as far as the tax is concerned, and as far as the model tax treaty or tax convention is concerned, they have basically the same meaning. So I'll use convention and treaty interchangeably. Then I'll first explain about the double taxation, and after I finish my explanation on double taxation, I'll move to the fiscal evasion matter. First, what is the double taxation? Double taxation occurs where residence country and source country impose tax on the same source. Juridically, double taxation is described as the imposition of income tax by 2 or more tax jurisdictions on the same taxpayer in respect of the same taxable income. Let me make one example here. Well, for the instruction purpose, during our discussions on tax matter, what I'll use 2 capital letter here. One is R and one is S. R stands for residence. S stands for source. Well, double taxation is the problem occurs because the residence country and source country claims they are taxing right on certain income. So, as I explained to you, double taxation occurs because of the combination of the residence principle of taxation and source principle of taxation. So I'll first here explain about the residence principle of taxation first, and secondly, I'll explain about the source principle of taxation. First, residence principle of taxation is like that. Well, in the international aspect, claiming taxing right on certain income, there's a 2 way of claiming the tax tax on certain income. Let's take the example here. Here's the company R, and it earned all the incomes all over the world. And the state of R, country R, can claim their taxing right on the income earned by the taxpayer R. This is the residence principle of taxation. This principle is based on the principle it claims based on the, I'll explain later, but principle of personal privilege for the jurisdiction. So in short, what state R claims is that R has a right to tax on taxpayer R, which is the resident. Secondly, second principle is source principle of taxation, where let's just suppose that a certain person earns income in state S, and that state S country may claim the taxation on the income earned by the resident R. In that case, the principle they claim is the source principle of taxation. Let's take one example here on the interest income incurred between two countries. There is a R country and S country. There are different independent territory in the international world, and R company is the residence of state R, and S company is resident of state S. Let's suppose that. And because S needs some funds to make investment in their territory, S company decided to take a loan from R company, which is the resident of country R. In return for the taking a loan from R company, S company pays interest income to the R company. In that case, there are two claims can be made by R country and S country here. First claim is made by S country because the interest income is accrued in the territory of S. And secondly, that interest income accrued here can be claimed by country R because it is the income made by country R company. So, in short, there are two claims combined here, and without the tax treaty or certain proper measures, there is a problem of double taxation because on one income, there are two claims made by R and made by state S. This is called double taxation problem. So, residence principle of taxation is that the principle according to which residents of country are subject to tax on their worldwide income. As I explained to you, because the R company is the residence of R country, all income they earned from all over the world, including this interest income, our country can claim the taxation on the income earned by residence country are. This is the residence principle of taxation. And this principle is related to the principle of personal privilege for a jurisdiction. This principle is that a certain jurisdiction, in this case, country R, can claim their public right, including taxation, for the person located belongs to their jurisdiction. In this case, our company. Second principle is source principle of taxation, which means a principle according to which a country may tax on income having its source in that country regardless of the residence of the taxpayer. Whether you are the residents of country S or not, you have to pay some tax accrued in the territory of source country S. This is pretty much like from the principle of territorial privilege for jurisdiction. The reason behind the taxation under the source principle of taxation is that because the certain taxpayer earned income in the territory of country S, you have to pay some tax on that income accrued in the territory of S country. This is the source principle of taxation. So as I explained to you, without proper measure such as tax treaty, income from the international transaction is subject to double taxation or sometimes multiple, sometimes quadruple taxation. So you need certain measures to lessen the problem of double taxation. Otherwise, you will have a much higher obstacle compared to the domestic transaction between the taxpayer. That is why we need the tax treaty to avoid the double taxation. Let's take the example here, coming back to the last slides. If it is one country, what our company has to pay is one time, has to pay is the income tax imposed by one government. In contrast to that, because this is the international transaction, there are two countries claiming their own taxation on one income. This is the double taxation issue. Second objective of tax treaty is prevention of fiscal evasion. What is fiscal evasion? Fiscal evasion is intentional illegal behavior or behavior involving a direct violation of tax law in order to escape the payment of tax. It is also called tax evasion. Tax evasion is generally accompanied by the penalty, financial penalty, and not always, but usually it is accompanied by the criminal charges in nature because it is the violation of tax law. So there are a level of compliance. According to the compliance, there are a level of 5 definitions from the pure compliance to the tax evasion. First, pure compliance is that the taxpayer pay their tax according to the legislative intent. So they pay what their tax law intends. That is the pure compliance. Tax mitigation is that the taxpayer is trying to reduce their taxes intended by the tax law. For example, one company make a tax file return for the reduction of their tax charges because they put their resources and funds to the R&D activity. In that case, tax law usually provides the tax credit on R&D expenditure. So by using that R&D credit, they reduce their taxes. In that case, that is tax mitigation. It is intended by the law to make the incentive to the R&D behavior or activities. Third is tax planning. They arrange their transactions and relationship to take advantages of the benefit permitted under the domestic law and treaties. So basically, it is allowed. It is not intended, but allowed under the law. Tax planning is just the middle of the tax avoidance and tax evasion and pure compliance. It is not illegal. It is allowed. However, it is not intended in a way. So tax planning is the way to mitigate their tax payment, but at the same time, sometimes it is tax legislator changes their law to reduce the activity of tax planning. Fourth level is the tax avoidance. This is the arrangement yielding result, which is definitely not the intention of the tax law. And finally, in the lowest one is tax avoidance. It is the falsified tax return in some times, and all the relevant facts are not disclosed or false information is provided to the National Tax Service. So the reason behind the fiscal evasion is the illegal practice of the tax evasion or fiscal evasion is underreporting, made by the underreporting. Sometimes it is accompanied by the bribery to the tax official, and sometimes it is related to the refusal to pay the right amount of tax to the National Tax Service. So basically, sometimes relevant facts are omitted, concealed, misreported, or additional false statements are presented as correct to the tax service. This is all the aspect of the fiscal evasion or tax evasion. Well, as I told you, to the extent if it is intentional, it amounts to the fraudulent conduct and it is punishable by the tax law. Well, sometimes it includes the penalties more than financial penalties. So tax evasion is occurred by the weak surveillance system, rampant corruption, complicated tax law, and tax reduction offering made by certain person to the taxpayers, and made by the lack of transparencies in government expenditure. So this is all the reason behind the fiscal evasion or tax evasion. And the reason behind those fiscal evasion, one of the main reason is in the international transaction are the bank secrecy rule, and the lack of exchange of information between two tax authority of each country. So OECD organization and many countries try to provide to eliminate bank secrecy rule. So, for example, around 10 years ago, Switzerland has a very strong bank secrecy rule at that time, and that bank secrecy rule is the main reason that many of the tax evaders hide their funds in the Switzerland bank. But around 7 years ago, Switzerland decided not to apply bank secrecy rule to the taxpayers, and Korea is one of the countries to have a tax treaty exchanging their information with Switzerland government, including bank information. So now, you may see some examples that disclosing the tax evading activity made by many taxpayers all around the world. Sometimes it involves a high-level society, including president of a certain country or government secretary of certain country. Here's the one example of tax evasion. This is only one example of tax evasion, which is converting the income source from one country to the tax haven, which is lower tax territory. Well, let's take one example, which is called the sandwich structure using the Irish company. Let's take example here. Here's the parent company. It earned the royalties from their IP rights. They earn lots of money. But there is one problem, which is in their territory, state our country imposed lots of tax to the income made by the royalty. So what they decided is to establish a subsidiary in the low tax territory. They didn't impose high tax to the taxpayer. So they moved their all IP rights to the subsidiary. After transferring their IP right, the situation occurred is that all the users paying their royalty to the subsidiary instead of parent company. The result is that they can defer all their tax payment for quite a long time because there's no tax here unless they pay the dividend. Well, if they pay dividend to the parent company, it could be taxed by the state R. However, they can defer to the very long time, and by using this kind of structure, they can avoid their tax payment otherwise incurred imposed by the state R. So this is the simple example of conversion of income sources from the high tax territory to the low tax territory. So what I have explained to you in the first session of tax treaty is basically on the double taxation and fiscal evasion or tax evasion. And as I told you, objectives of tax treaty or tax convention is to prevent the fiscal or tax evasion as well as for the avoidance of double taxation. So, although objectives of tax treaty is to minimize double taxation, excessive taxation, or uncertain taxation, and tax avoidance and tax evasion. Well, to do so, tax treaty is trying to remove tax obstacles and distortions to cross-border trade and investment flows, and thereby they are maximizing global wealth by ensuring an efficient allocation of resources. So, how do treaties achieve these objectives? First, eliminate the most common form of juridical and economic double taxation. I'll explain at the next session how to eliminate this kind of double taxation and eliminate or reduce some taxes that would otherwise be payable by foreign investors, and eliminate some forms of tax discrimination, and provide standardized set of rules for dividing tax revenue between countries. I'll also explain in detail about the dividing of tax revenues between countries. All issues are related to the double taxation or the elimination of double taxation. And second issue is the tax evasion, address the tax evasion and tax avoidance. And it provides the framework for settlement of tax dispute and provide a stable tax environment to the foreign investors, and increase by providing such instruments. Tax treaty can increase the international competitiveness of the economy. Well, this is the first session. I explained to you all about the objectives and the problem of double taxation. This was the first session. I explained about the objectives of the tax treaty and the overall view of the tax treaty. So next session, I'll explain about all the articles of the model tax treaty. So we'll see you at the next second session of the model tax treaty.